Good evening. Welcome to Markets Today. I'm Lata Mkts. With me is Surabhi Upadhyay. Market went through some blues, I must say. A 2.3% cut for the Sensex and the Nifty. The Midcaps almost that much, 2%. But the Bank Nifty was the one that really pulled the markets down. Just about any bank you picked appeared to be between 5 and 7% lower just on the day. But it wasn't really India's doing. It was an Asian tsunami. It started off in China, PMI data, and then some small factories data. All of them took their toll, first on Asia and then on the European markets, and India was just sandwiched. Hi, Surabhi.
Hi, Lata. Yes, that big fall in bank stocks today really breaking the markets back. We'll talk about that and a lot more. Let's start with the headlines. Global woes corner bulls on Dalal Street once again. Benchmark Indices tumble 2.3% with the Nifty falling below 7,800 at close. The Sensex drops nearly 600 points. All sectors end in the red with banks, metal and real estate stocks being the worst hit.
The Bank Nifty cracks 3.6% with blue chips like BOB, Kotak Mahindra and State Bank falling between 3 and 7%. Punjab National Bank tumbled 7% as well after Fitch downgrades the bank's viability rating by one notch to BB, citing the mounting stock of stressed assets.
The Midcap Index falls 2%, faring relatively better than the benchmark indices, but still in negative territory. Jet Airways and Spicejet failed to take off despite the steep 11.6% cut in ATF prices. Midcap PSU banks like OBC, Karnataka Bank and IDBI Bank fall anywhere between 5 to 7%.
A mixed show from auto companies in August. Maruti misses expectations with total sales rising by just 6.4%. M&M continues to disappoint with a 5.7% drop in sales. The revival in commercial vehicle sales, however, continues for Ashok Leyland and for Royal Enfield. The numbers were much better. It ensured another bumper month for Eicher Motors. Well, those were the headlines that dominated mindspace in the markets. Here are some of the experts that we have lined up on the show for you. We'll get you a whole host of market experts like Ramdev Agarwal, Sanjay Dutt and Rajat Rajkaria, also of Motilal Oswal, with their take on the markets. Adrian Moat of JP Morgan will also join in to give us his perspective of the Chinese slowdown and its impact on Asia and on emerging markets. On Corporate Radar, we will have Pawan Goenka of M&M to talk about the company's August sales and about car sales in general.
Okay, so all that opinion and analysis coming your way, but first, the numbers themselves. The bears came back with full vengeance on Dalal Street, and the bulls simply had to run for cover. Markets lost all gains that were eked out over the last couple of sessions. As weak global cues spoiled the sentiment, Anuj is now here to wrap up the day's trading highlights. Anuj, every time the bulls feel that they're getting a little stronger or trying to revive, the bears come hacking them back.
Well, ugly day for the bulls today. Clearly no other way to describe it. The way the market fell in the second half. Yes, the start was bad because there were indications with the SGX Nifty and the way Dow was down. But the second half collapse really came out of nowhere for the market. There was incremental weakness, of course, from the European markets and the Dow futures as well. But the market really collapsed under its own weight. And you saw a lot of stocks selling quite a bit. The Bank Nifty is now back to October 2014 levels. The Nifty is at risk of going there if it does not hold on to the August lows. A lot of selling in individual banking names led by PNB and Bank of Baroda, but nothing was spared really. HDFC Bank, HDFC, ICICI Bank, Axis Bank, all these stocks saw selling pressure in today's trade. In fact, a lot of stocks like ITC, Reliance, HDFC Bank, ICICI are now in the classical bear market definition, with stocks having fallen more than 20%, and not fallen 20% over a period of 1 week or 2 weeks. Falling 20% over a period of time. It's been a slow, painful process for the market to correct, and that's really been more damaging. The Nifty corrected 185 points today, and not a single stock led more than 17 points or contributed more than 17 points. That was telling you the extent of the secular nature of today's market decline. It also came on relatively low cash market volumes, but very high F&O volumes. So there's a bit of a chance that we may have reached a bit of selling exhaustion. And, if the market has to hold, it has to hold 7,700 to 7,800. Otherwise, there could be lower levels. But the bulls would hope that the market may well make a bit of a double bottom at around 7,700, 7,800.
All right, Anush, thank you so much for that. But Lata, your perspective on what we've seen with bank stocks today. I mean, I wonder if it was just that big move from HDFC Bank lowering rates and the margin concern, or I mean, is
well, you could attribute, you could have started the day with some concerns for the banks because the GDP numbers were nothing great to write home about. If even a conservative Reserve Bank is looking at a 7.6 for the full year, then a 7% in the first quarter clearly puts a question mark over the numbers. And on top of that, you had this fierce competition coming from HDFC Bank. So you could have attributed to a weak start to the banking sector because of the competitive pressures. But a savage 3.6% correction, no way was HDFC's bank's competition responsible for this in any significant measure. This is quite clearly selling of EMs. And when you're putting question marks over the growth of the entire economy, then the first stocks you sell are the ones that are exposed to the economy. At one point in time, the dollar also cost about 66 rupees 40 paise. When the dollar rose as much as that and the rupee got cheaper, immediately the bonds start reacting because you think there's imported inflation, and then that becomes another whammy for the banks. You can beat the banks with everything when the reason for the fall is one, a slowdown in China, and two, a potential Fed rate hike. A Fed rate hike also is expected to have some negative impact on the currencies and therefore on emerging market bonds as well separately, and that also is negatively impacting the bank. So any which way you looked at it, it was very good to start selling the EM basket, starting with the banks.
And that's exactly where the bears chose to focus in today's sell-off. Let's actually get you some more color on what happened in the international markets. The Indian flu clearly started in Asia today. Official data from China showed that Manufacturing Purchasing Managers Index dropped to 49.7 in August from 50 in July. A reading below 50 indicates that the sector has begun shrinking. To add to that, a separate survey of smaller factories fell to a 6-year low of 47.3 from 47.8 in July. As a consequence, China's stock market fell over 2% in intraday action, finally ended the day over 1% lower. Even sharper losses for the Japanese Nikkei. That index tumbled 4%. The Hang Seng in Hong Kong lost over 2%. And of course, the Japanese Nikkei, as we've been telling you, lost almost 4%. The South Korean Kospi wasn't spared. That index ended the day 1.4% lower. So Asia having a very rough session of trade today.
Okay, now let's listen to some experts, global voices, on what they make of the Chinese slowdown and the Fed rate hike and the potential impact on emerging markets as an asset class.
It is important for corporate earnings for multinationals, so I would be worried about machine tool manufacturers because, you're not going to need all these new factories being set up. It's clearly going to hit the auto industry. It's hitting some of the consumer stocks. For a period of time, it's already been hitting luxury goods. But I would say about the stock market and the wealth effect, there was no evidence on the way up. I'm not sure if there's any evidence on the way down. And I think what we're missing here in terms of there are some good data points in China. Year-to-date, property sales are up 20%. The property market is significantly bigger in its impact on the economy. So there is a little bit of good news, although the bulk of macroeconomic data is still pretty poor in China.
First is the weakness that we're seeing continued out of China. As you mentioned, the PMI figures have been generally soft. I think the second thing is that people are still absorbing the news that we had out of Jackson Hole over the weekend, where I think the Fed officials made it quite clear that they are making policy with respect to what's going on in the United States domestically and not for the entire world. And what they're seeing in terms of the United States domestically is an economy which is doing pretty well, and where they feel that economy could probably deal with higher interest rates. I think it's a combination of the fact that the rest of the world, and particularly the emerging market world, is under some pressure.
We're seeing another bout of risk aversion on concern about China's economy. We've seen, obviously, some very volatile markets, but clearly the surveys from China that we saw overnight have reinforced some concerns about a sharper economic slowdown. The mood certainly in Europe is not great, but that generally relates to what's happening globally rather than particular concerns about the domestic situation.
All right. Nevertheless, despite the global headwinds, the consensus view on India still remains positive. Now, here's what Ramdev Agrawal, joint MD of Motilal Oswal Financial Services, had to say.
This time what we are seeing, the difference is that there is of course drop in the market, the global macros are moving here and there, oil is moving, currency is moving, commodities is moving, everything is with the chaos all over, perfect chaos. So, but in that there is no fear. People have gone from here, but they are not fearful, they are not panicking that okay, whether I will be able to sell or not. You know, even the IOC deal just got done, and in 2 days stock is 10% or 7-8% higher than the issue price. So I think there is no fear in retail as well as the foreigners. Let me tell you about macros also. The world might say that this is the end of the global economy. So the economists all over the world put together, they always announce every 10 years end of this country or this economy or the world has come to an end. I hope things will turn around. You see, who knew that oil is going to go to $55? In 48 hours before it was $42 and it was looking as if it is going to 30. Today in 24 hours it has turned around to 55. So nobody can predict this thing. Let's hope that everything will fall in place. Macros will fall in place, micros will fall in place, we'll get enough ideas and we'll make the set amount of money.
Right, now that was a bullish Ramdev Agarwal, but actually there were quite a few bullish voices. Sanjay Dutt of Quantum Securities also reiterated that he would use the dips to pick.
Fundamentals are very clearly pointing out as far as India is concerned, as far as key economies worldwide are concerned, whether you look at US, things are better there as well as things are better here. And like I said, it's the, primarily the commodity EM and China trade that's playing out right now, which we are all caught in that, draft, a very strong draft. And we'll find attractive levels, we'll find very attractive prices of stocks that we like, but in no way are the price indicative of a bear market. Contrarian part of me, having seen real low prices and having seen, who kind of wants to take that extra risk for the extra profit, will say Tata Motors. The conservative side of me would take a call on Tech Mahindra. So, I'm trying to put this kind of very simply for investors across who are watching, that if you're a little, if you can't stomach risk and if you can't really, live with too much negativity around, don't buy Tata Motors. You want to be comfortable, buy Tech Mahindra. But if you're willing to, stick your neck out and make that big trade and big money with a high level of risk, go and buy Tata Motors.
All right, so there are still a couple of bullish voices, more than a couple of bullish voices on Dalal Street. But shifting gears now to Motown, it's the start of a new month and auto sales figures from the earlier month are trickling in. It looks like another mixed bag of sorts. Sonia Shenoy is joining in with the analysis. Sonia, what's the picture looking like?
Oh, well, yes, it was a mixed bag this time around as far as the auto sales are concerned. But the big disappointment really came in from Maruti. That one has been reporting stellar growth for the last many months. But this time around, the sales for Maruti came in at 6.5%, single-digit sales, and much lower than what the street was estimating. The export sales have been quite weak, so exports are down more than 11-odd%. But domestic sales were not bad, up about 8.5%. If you look at the segment-wise performance for Maruti, the compact car sales, which is your Swift, Ritz, Celerio and Desire, were down about 11.5% this time around. So that's where the numbers got hit. Then there was Eicher Motors, which reported a very strong Royal Enfield sales. So that trajectory continues. The total sales for Royal Enfield went up almost 60% year on year. The models with up to 350cc engine went up about 61%. So good going for Eicher Motors. Ashok Leyland as well reported very good numbers this time. The sales growth of Ashok Leyland came in at 39% year-on-year at 11,544 units. That's because of pre-buying that we have seen ahead of the ABS or the anti-lock braking system norms that will kick in come the 1st of October. So from the 1st of October, it will be mandatory for every truck to have an anti-lock braking system and a speed controller. So the truck prices will become more expensive, and that's why we saw pre-buying over there. But the other big disappointment that came in apart from Maruti was in M&M. The August sales were below expectations because of a big fall in tractor sales. So tractor sales were down 22% on a year-on-year basis.
Thanks a lot for that, Sonia. Ahead of the SIAM, the Society for Indian Automobile Manufacturers annual convention that kicks off tomorrow in New Delhi, CNBC TV18's Ronojoy Banerjee caught up with Pawan Goenka, the Executive Director of M&M, asked him about the company's August growth as well as generally its growth outlook.
where we are today is perhaps not where I would have expected us to be a year ago. Yes, we have had growth in passenger vehicle, we have had growth in heavy commercial vehicle, but the growth has not been uniform and not in all segments. The segment that's suffering very seriously is the small commercial vehicle, where we have had almost 3 years of degrowth now. And even in the passenger vehicle, I think the growth percentage is lower than at least what I would have expected. I frankly think that there is something holding customers back. There are a lot of positives that are happening today in the economy. Yes, of course, there are concerns also, but there are a lot of positives that we have, and I would have expected us to be in a better position today than where we are.
All right, time for a break now, but coming up on the other side, more market opinion from Rajat Rajgaria. Don't go anywhere.